When I first got introduced to trend following, and especially the turtle trader story and Richard Dennis, I was always fascinated by Liz Cheval, one of the two female traders in the turtle trading program. Now, there's always been some controversy about that particular issue, and I address it in my second edition of my Turtle Trader book. And it will probably never be resolved, but there you go. Everyone can have their opinion about whether there was one or two turtle trading women. But it was inspirational because it did give a certain sense of the diversity that Rich Dennis was looking for, the different types of people that he selected. And most all of them did really damn well. Today, I reach back and I bring on a trend-following trader, Kathy Kaminsky. 2 episodes back to back. A very smart trend-following practitioner. If you can't learn something, there's something wrong with you. I hope you enjoy. Today on the show, I have Katherine Kaminsky. She is founder of Alpha K Capital, LLC, a thematic fund of hedge funds focused on offensive strategies for tail risk management. She is also a contributor to CME Group. She earned her PhD at MIT and worked closely with Professor Andrew Lo. Her new book is also out, called Trend Following with Managed Futures, The Search for Crisis Alpha, written with Alex Gracerman of ISAM. For those of you that recall, Alex has appeared on my show before, along with Larry Height. I hope you enjoy this conversation with Katherine. I'm going to give you the opportunity to talk a little bit about yourself here in the beginning. So for my audience that might not be familiar with you and your work, but one of the things I want to offer as a compliment right out of the gate is that you and Alex Gracerman, your co-author for this new book, Trend Following with Managed Futures, The Search for Crisis Alpha. What you have given me, as somebody who's written a few books on trend following, is you have finally put to bed, I think, for one of the biggest criticisms I've received over the years is, Michael, you just ignore survivorship bias. You've picked the lucky monkeys that happen to be banging on the keyboard, and this trend following stuff is all no good. And just look at that baseball owner in Boston. You know, he made all this money and and the stories just go on and on and on. You and Alex have put down the academic proof that really makes that a tough argument now.
That's a fantastic compliment. That was, if you say that, then I'm really happy, because honestly, our goal was to try, I hate that the academics have just basically ignored us until recently. And, this strategy has been viable for 15 years since I was first interested in these type of strategies. And my academic colleagues basically told me that, this is voodoo. This is not interesting. And then, I totally agree with you. And so that's a great compliment. I appreciate that. So,
well, you mentioned 15 years. Clearly some of the longest standing CTAs probably can say their track records like done.
Doing it for 40 years.
Yeah. So, and Richard Donchian's first fund was probably in the 50s. So, and then you could go even farther back, like you guys do in your work. You guys go back 800 years. So listen, tell me something about you, though, and your background, because frankly, from a woman's perspective, there's not been as many women prominently involved in the trend following space. I know one of the most prominent ones, unfortunately, she's deceased now, is Liz Cheval, but there just hasn't been. And you are clearly, with your work, you're leaving a lot of guys in the dust, to say the least.
Well, my background actually I'm originally from Nashville, Tennessee. And then I've always been a huge fan of math. Ever since I was a kid, I was had this proclivity towards quant. And then I ended up going to MIT and doing my undergraduate in electrical engineering. So, I started being around guys pretty much most of the time anyway, so I'm pretty used to it. And then I went on to do my PhD at MIT, also in operations research. And I worked with a professor by the name of Andrew Lo. is also quite well known in the quant space. And I guess for me, I never really thought about it so much. I just always have been such a math geek that was much more important to me than maybe the balance of gender equality.
No, and I wasn't trying to make an unusual point, but it is unusual because I think I've received some criticism from people. Sometimes they say, Mike, you don't have enough female guests on your show. And it's like, well, hold on.
Well, there's not that many female guests to ask. I mean, I say it that way, but I mean, I think that, I think it's a shame because it's such an exciting and interesting field. And I've met a few interesting women in the field. And I think that hopefully as we see more women in the field that, will open up to more women coming into it as well.
Well, I think for those people that are paying attention, they know immediately when you say PhD, MIT, math, finance background, so they know you've got the chops. I don't think there's no questioning there. Let me kind of circle back and go into something that I think is really, really important from the beginning and in discussing your new work with Alex. And this is the idea of a convergent type risk taking or strategy and a divergent risk type strategy. And it is so, and there's this great chart that I printed out here from, I think it was from your TED presentation. And this just fantastic left-right chart. On the left side is convergent, on the right side is divergent. A convergent strategy, many small wins, extreme losses to the left. A divergent strategy, many small losses, extreme gains to the right. And I would love for you to set up, and you can use some non-finance examples too. And I thought the venture capital example is something that I've been thinking about forever, the natural kind of symbiotic relationship between a trend following style investing and venture capital, same, as they would say here in Asia. But why don't you talk about and open up for my audience the convergent, divergent thinking and your thought process there?
So I think this is a fantastic way to understand what trend following is really about. And in the following sense that, in life, you can really sort of step back and think that pretty much everything we do is risk. And sometimes these risks are sort of more quantifiable, and sometimes they're more about uncertainty. I think that we need to use a combination of approaches to deal with any of the risks that we're faced on a daily basis. For certain scenarios and under certain conditions, one approach is better than the other, but that's a time-varying thing. So how I would explain the difference between convergent and divergent is that convergent and divergent approaches depends on how you see the world. So if you see the world as sort of knowable and somewhat stable, quantifiable, then, you already sort of sitting in a framework where you have some sort of set of beliefs about the system. And when you're in that frame of reference, you're going to be more likely to, for example, take your gains. But when you're wrong, you're actually going to double up on your position because you're going to think, this goes against what I believe and what I think should happen. On the other hand, divergent risk-taking approaches are more for the philosophical idea that you say, look, I don't really know what's going to happen. I can't predict the future. I just know that the structure of risk and things that are sort of impending to me are just too complicated for me to really make a very discrete view about the world. So in that case, I'm going to use a set of heuristics and approaches that sort of are a little bit more agnostic to predicting the future and to having a belief. So when you're a divergent risk taker, what you do is basically when you lose, you don't necessarily believe that you should sort of follow that particular strategy, so you cut your losses. But when something goes your way, you follow that train. And this is exactly what trend following really is. It's really about spreading lots of risks across many different positions, where the intrinsic part of cutting the losses and following the winners gives you this divergent risk-taking strategy. You asked me a question about examples, and what I think is so powerful about this dichotomy and this sort of way of thinking about it is that you can think of examples in every part of any type of risk that you take in life. Finance is not an exception. I would say that social networking and how people network with other people is a very good example. Some people are convergent risk takers. They have a small group of friends that they sort of nurture and develop. And when they lose one of those, they become very vulnerable. So they have negative skewness. On the other hand, some people who are very good at sort of social networking with large groups, they tend to go from person to person, knowing lots of people, and then looking for the big opportunity that they might make with a business deal, for example. In the finance world, you already brought this up, Michael, but this is a great example, I think, and this dichotomy that you see in the private equity world, that for leverage buyouts and for more sort of mature LBOs, what you see is that they use fundamental analysis and they have a much more structured view on the way that they invest in particular companies. On the other hand, venture capitalists, what do? They spread their risk across many small, sort of good investments, hoping that they can find the next big LinkedIn or Spotify. So they have positive skewness and right fat tails.
One of the great examples that I'm thinking of as you talk about convergent divergent is Apple Computer, and not just a price chart of Apple Computer, but I'm thinking back to when Apple would first release products. They're famous for a computer they released called the Lisa that was a bomb. And what's really interesting, you go back through the press, people still harp on this as it was a big defeat. But if you're Apple Computer, you don't know what is going to be the big hit. You don't know what's going to be the iPod that takes off, that becomes the iPhone. You have to try new things. So an entirely divergent type thinking, whereas the critics of their divergent style of developing new products were those exact convergent people that could not accept the idea that there could be a failure. There could be a failure and that you move on.
I totally agree. And a good friend of mine here was giving a talk about success. And what he said was that you must fail and fail and fail to succeed. And I think that sort of this idea of cut your losses, just fail, but fail smartly, intelligently. And that's kind of the idea that, you're getting to with the Apple example, is that this is more an ideology, a way of thinking about risk over time. And I think that what we say in the book is we say that in situations where things are really uncertain, that's when, this divergent approach is often much better, because you're not too stuck in your ways. You're not you don't have a worldview that is basically being challenged.
Yeah, you don't know what's going to happen next, so you just go with the flow.
And I think it's quite fun to talk about this convergent, divergent approach, because people have a sort of visceral reaction to it, because they kind of think about how do I behave? How do I handle risk? Am I divergent in the way that I handle my risk, or am I convergent? So
I think it raises an emotional issue for people too, because like you're saying right there, it forces you to do an interior inventory. Like, what type of person am I? And for Americans in particular, most Americans like to imagine themselves as a cowboy leading the pack. But a cowboy leading the pack is the divergent strategy. And the reality is I don't think most people can really accept or get on board, at least yet in human evolution, can get on board and be comfortable with divergence. They want what they perceive as stability, even though, as you and Alex point out, that perceived stability can often wake up and bite you in the you-know-where, and the next thing you know, that perceived stability was never really stable to begin with.
I totally agree, and I'm American, and I live in Sweden, and Sweden is a country with a very different culture affinity for this. And when I give lectures on this here, I find that people all want to be convergent. I'm pretty sure if I gave the same lecture in the United States, more people would want to be divergent, because culturally it's considered chivalry. It's considered like the cowboy, like you said. Right. Very exciting to be the inventor.
Let's jump into a couple of the meaty big topics in your work with Alex. And this is not something, look, we can, even in a few hours, if we were talking for a few hours a day, we can only touch on what you have both put together. But I thought what was interesting is right there in the preface, and you mentioned Andrew Lo at MIT, very well known, very well respected. And he wrote a really great preface for the book. And he mentioned three things in particular that for the trend following community has always been difficult: and the efficient market hypothesis, the idea that this trend following stuff is voodoo, and this lack of transparency. Now, I think each one of those issues, for the critic's standpoint, at least when I look at the critic that uses those issues, I always just think, well, either the critic
is being lazy, or the critic is just defending their own book and they realize that trend following is something that causes them to have to talk about issues that maybe they don't want to talk about because their strategy is entirely different. But nonetheless, those three issues are critical issues, I think, and you guys start to, in your work, to tear each of those apart.
Yes, I mean, and I think it's really nice to see that even in the last 2 or 3 years, the entire basically momentum cross sector, now they call it time series momentum, but that's what academics call trend following. Ultimately, it's become sort of an accepted research topic, and it's one that academics I meet are interested in listening to. So I think that is sort of we can sort of wave the flag for trend following, that we've sort of been accepted into the mainstream finally. It took long enough, but I think most of those issues, especially the efficient markets issue, is one of the greatest adversaries that we've had. And as people sort of have started to accept that, efficient markets is one way to see the world, but that doesn't always hold, especially not over time, then they become more and more open-minded to understand that it's really not, that's a little bit too simplistic way to view markets.
Yeah. Let me slide into the idea of, let me bring back to voodoo, the specific term which you guys use in your text. I mean, there are quite a few people out there that still, and I would position them as intellectually lazy to describe something like trend following, especially now with the work that you and Alex have put together. I mean, if somebody looks at that book and says this is voodoo, I mean, they're just whistling Dixie and making up stuff. But the notion that for so long, so many people, was it just that they couldn't wrap their arms around it? I mean, I still remember looking at this stuff in the early to mid 90s going, oh my gosh, who is this guy Bill Dunn? Who's this guy John Henry? Who's this guy Keith Campbell? This guy Jerry Parker? Look at these returns. Interesting. All the returns are correlated often on a monthly basis. They're all doing something similar. This is fascinating. Why is this not being written about all the time? And I'm sure you had your aha moment at some point in time too. When did you have your aha moment that this particular field was really just, you were like, oh wow, I really want to sink my teeth into this?
So I think it was a long time coming, but I remember the first time that I was very interested in sort of, especially for this paper that I wrote on crisis alpha later. This actually happened as a grad student. I was a student of Andrew Lo, and so we were going and learning about the adaptive markets hypothesis, and he was writing a lot of stuff about adaptive markets and seeing things in a different way than efficient markets. And I remember a good friend of mine who you may know, Yasmina Hasan-Hodjiks, who's written a bunch of books on technical analysis, not in trend following, but she was talking about how well technical analysis worked in currency markets. And I thought that was so fascinating to me because I said, wait a minute, so you're using the most liquid, most efficient contracts to trade using technical indicators. Isn't that sort of at odds with the theory altogether? Because if you believe in efficient markets, then you should never be able to use past prices or information to trade. And how come it happens to be the case that these strategies, okay, technical analysis is different from trend following, but how come it's the case that, it works there? Something weird. And I remembered that moment. And then several years later, when I was studying trend following and thinking about crisis alpha, what happened was people kept asking me, why does trend following work in 2008 or in a crisis? And I thought, well, if you go back to the efficient markets, well, trend following shouldn't work ever based on that assumption. But if you think about adaptive markets, then you think, okay, so adaptive markets is really about the composition of players in the market and the environment that controls who's going to succeed and fail. And so if you think about the world from that perspective, I thought back and I said, wait a minute, trend following is applied on the most liquid, most efficient markets out there. So it must be that this efficiency and this sort of ease of trade is at the core of their advantage in a difficult crisis scenario. So basically, when I went back and I did a lot of analysis, and I realized that, wow, actually, this argument makes a lot of sense. When the market changes and there's a a crisis situation, this is exactly the moment where the environment is challenging for most players, whereas trend followers have the ability, because they're sort of diligent in the way that they apply risk, to profit from this sort of odd, difficult scenario. And that's how that all came together. But I can definitely say the first time I thought about it was in discussions with Yasmina about technical analysis. And that was, I don't know, maybe in 2003 or something like that. But it all sort of came together later when I was thinking about trend following more. I think it's really once you assume that once you get into thinking things from an adaptive markets perspective, it made a lot more sense to me. If I had been thinking about the world from an efficient markets perspective, I wouldn't have actually it wouldn't have been a question in my mind, is what I would say.
I had a note here to ask you about it, but as you've brought it up, let me get you to define it a little bit more as a professor teaching maybe the general population out there. Obviously, my audience there's some that are beyond a general understanding, but the idea of the adaptive markets hypothesis, put that in terms where somebody can reasonably grasp it, assuming maybe they've heard about the efficient market hypothesis.
Okay, so if we go back, I'll start with efficient because that's maybe a little bit efficient markets hypothesis basically says that all information is incorporated into prices. So what this means is that you can't go out there and do any sort of analysis and make money off of it because the markets are so efficient and there's so many people competing that there's no opportunities. Okay, that's efficient. Now, adaptive markets hypothesis comes more from a biological view of the world. Efficient's a little bit more about physics, sort of thinking that everything goes into equilibrium and sort of there's nothing left. F equals ma. The adaptive markets hypothesis is more about thinking about the world as an ecology and the market as an ecology. And we can think about, in that perspective, everybody who's participating in the market, so that could be hedge funds, HFT traders, pension funds, individual investors, everyone are sort of members of this market ecology. So it's a combination of the distribution of players in this market ecology and the opportunity set and resources which are available, which define sort of how the ecology evolves. What Andrew has sort of built up in his work is sort of a framework where we can see markets more like ecologies. And therefore, what we have to do is step back and say, okay, what is the distribution of players in this ecology? And what is the certain set of environmental factors that we're dealing with? And how is that going to play out if we want to think about who's going to succeed and who's going to fail? And that's sort of the way that you want to think about it. It's more about biology, about ecologies and understanding sort of the forces of natural selection. Competition and sort of fighting for resources will help you to understand better how financial markets work.
This gives the adaptive markets hypothesis, this gives that foundation for why trend following can excel during these crisis alpha periods, correct?
Yes, of course. And this is why when I went back and did the analysis, what I found is that, on an average day when there's not, where it's a highly competitive environment, it's not that obvious that trend following is going to make money. If you look at the return profile of trend following, they have a lot of losses. But the difference is that this strategy is poised and ready to move when markets diverge. So in the book, we talk about divergent risk taking, and then we say that trend following is not long volatility, it's long divergence. And what divergence comes from is actually the reallocation of resources and forces within this ecology that is the market. So from time to time, there are moments where things happen in markets and it takes longer to adapt than efficient markets hypothesis would predict. And we can take 2008 as a perfect example of that. In the adaptive markets world, this is something which Andrew and evolutionary biologists would call a punctured equilibrium. So what does that mean? Well, when an equilibrium gets destabilized, it takes some period of time to restabilize itself into a new equilibrium. And divergence is sort of the result of that. Now, what does divergence mean? It's when prices are somewhat more predictable than a random walk, for example.
We've been talking about it, but the phrase crisis alpha, are you responsible for coining this term?
Yes.
Yes. So why don't you define it from your perspective, crisis alpha? I'm sure people out there in the audience are thinking, well, I know what that means, but they really might not know what it means. So why don't you define it?
Crisis alpha are the alpha opportunities that are available when there's a financial crisis or severe financial dislocation. And what I would say is that trend following as a strategy makes money outside of crisis as well, but crisis alpha is called alpha because nobody else seems to be able to deliver it. And it's not something that's that easy to sort of just capture without implementing the strategy as a whole, because many different investors have asked me, well, I know I can just, change my positions right before the crisis. And it's, and I just laugh because I'm like, no.
And the funny thing about that too, is that as we're talking about crisis alpha, it's not like trend following traders are sitting around predicting a crisis. They don't know any more than anyone else, but their strategies typically put them on the right side of surprises.
Yes. And so when I was asked to explain crisis alpha, what I said is we have to step back and think about the environment of a financial crisis. There's three things that happens when there's a financial crisis. First, when equities go down, people lose. And in aggregate, you're sitting in a world where most people are losing money. And if we believe at all that behavioral finance has an impact on markets, this is going to be the time where it's the most severe. So people are going to be driven by their sort of behavioral biases more during crisis than during other times. Second of all, most of the rules and risk management techniques that we have today are contingent on loss rules, drawdown, increases in volatility. So we actually have an embedded natural reaction in our portfolios, regardless whether or not we consider ourselves rational or irrational during this type of moment. And finally, we all know that we have a home bias towards equity markets. And whenever equity markets move, it tends to have impacts on other markets as a result. So other asset classes like commodities or interest rates or FX as well. And so what we're talking about during a financial crisis is a period where the most amount of people are somewhat driven or forced into action in markets. So if you think about that from an ecology perspective, things are really sort of behaving in a very erratic way during a crisis period, which means that there's more divergence in markets. And when there's divergence, a trend following strategy is basically set up to profit from divergence in prices.
The long only bias, which you see across the broad collection of assets out there, this long only bias, the fact that people have this long-only bias ultimately is a significant aspect to why the crisis alpha opportunity even comes to exist.
Yes. And I mean, it's not a bad thing. I mean, I don't think that, my personal view is it's good to be convergent and divergent. That's what I would say. So any portfolio should have both. Just like in life, you have to have both. You should be convergent sometimes in some things that you do, and you should be divergent too, so that you experience some of that upside, some of the following the trend.
You know what's interesting though, as we talk about that, I wonder if we were having this conversation as two Japanese academics, with the comparison basis being in the Nikkei, down significantly since 1989. I wonder sometimes, for those that are doing research or writing about trend following like you're doing, like I've done some, that you have to, when stock markets are at, for example, right now, like all-time highs, you kind of have to play nice a little bit. But the reality is these things could change dramatically, and there's no guarantee that equity markets from a buy and hold or long only perspective have to remain at all-time highs. They could go in an entirely different direction. And then on the flip side, if you're making a comparison to, for example, the adaptive markets hypothesis, talking about looking for crisis alpha using trend following, you could imagine, if you walk forward, entirely different scenarios where maybe even a much larger portion of the population is saying, wow, tell me more about this trend following. I think less people want to know when the markets are at all-time highs. That's the quick and dirty of it, I think.
I definitely, but then you can just go back to sort of behavioral psychology, and when things are up, nobody ever wants to think they'll go down. I mean, and I think that's exactly the point, is that that's very convergent, and people become more convergent the more that things look like they're certain. So the more things become certain, the more convergent people can tend to become. And then some of the people who are a little bit skeptical start to say, maybe I should just sort of hedge my bets a little bit and try something a little different and it's sort of like, we made the joke of talking a little bit about private equity. Maybe at some point it's not good to have all your eggs in that one type of basket too. You need to sort of be able to take different approaches to risk, because I'm sure that people that were invested in private equity, when they saw their friends in venture capital making a killing on, the IPOs of LinkedIn and those type of things, started thinking, there's something else out there in this space that's interesting as well. And I think you're totally right. I'm actually I find it kind of frightening, because Alex and I had been looking at the S&P 500, and the last 5 years is in the 98th percentile for all 5-year rolling windows of the S&P 500 since 1928. And for me, maybe it's because I'm a little bit skeptical, it makes me a little bit concerned. It doesn't mean that I know when something will happen or that I could predict when it would happen. It just tells me that that is definitely statistically an outlier in terms of performance of the S&P 500.
You're a numbers person, and you're looking at it statistically, and you're saying, not emotionally, you're just saying, from a fact standpoint, 98th percentile, boom, there it is.
Yeah, I mean, I don't know. Maybe it's going to go to the 99th percentile or 99.5. I mean, it could, definitely.
Let me shift on you a little bit more. I'm going to touch on a couple more topics while I have you this morning. You and Alex had the ability to go back and look at data, and I would love for you to tell this story a little bit, how the data came to be, perhaps how you looked at it. But you didn't just go back 50 years or 60 years or 70 years or 100 years or 200 years. You've attempted to look at data going back 800 years and draw trend following inferences from that data going back a long time. And we're going back, I'm currently in Southeast Asia. I'm really close to Cambodia. I've been to Angkor Wat, so we're talking about going back to Angkor Wat times. That is where you've taken the research. Why don't you explain that?
Okay, so, I think that was an exciting part of this book, because we wanted to start with history, because we think that history sort of frames people's frame of reference, and it builds and it basically makes things relevant. So, granted, the mathematical techniques are not as precise with such a long historical analysis, but it still helps us to think, over centuries and centuries of time, was this a good risk-taking strategy? Why was it in the 1800s? I think we quoted the David Ricardo and his quote, and I have it here, but he basically said, "Cut short your losses and let your profits run on," in 1838. And what that kind of sets as the stage is that, this idea is something that's sort of ingrained in human behavior, and it's just momentum and trends are just part of financial markets. And that has been true since the beginning of time. The different techniques for doing it have become more sophisticated, but the idea is the same. And I think that was what beginning the book with this history and doing 800 years analysis and looking at inflation across different centuries and trying to think about that was not meant to be sort of a rigorous academic exercise. It was meant just to sort of create a historical and ideological understanding of how sort of innate trends are and how they're just a part of financial markets.
I don't know if you've ever been there, but there is a library around the Capitol Beltway in the Washington, D.C. area, and it's called the National Agricultural Research Library. And I have not been there for over a decade, but I remember going back there early on because I wanted to find early data. And it's one of the few places I've found where literally, given it was the federal government, and you could somehow or another, I talked myself up into the stacks on like the 20th floor by myself. And I'm literally like wandering around looking at, economists from back to inception. And I think I picked up a newspaper that was laying on a stack, and it was like the day after Lincoln was shot. I mean, it's just one of these great places where you could wrap your arms around early data. And the funny thing is, and you obviously you have seen this, but when you wrap your arms around early data, you just start to realize us human beings are not that novel today. That we've been doing the same things for a long time.
I totally agree, and I think that's what we were trying to do. And the goal of the book as well was to somehow start with history and then move into the science and the art. And I think that trend following, that's really a good way to explain it. The history sort of shows that trends are part of markets. The science is really learning about how do you cut your losses and follow winners, and sort of building a system and a framework for how to apply it. And the art is in how you personally apply it yourself. So I think it's all three of those. Yeah.
The idea of black box, and this is one of the favorite for the critics out there. And once again, I think I don't ever really just take what a critic of a particular strategy might say without wondering why they might be doing the criticism. It might not just be for intellectual curiosity. It might be for some other reason. But I've always found the idea, because if one really wants to do the homework, and you know this to be true, it's always been pretty easy to analyze what a public CTA is doing with their particular trend following strategy, even by just looking at the performance data. Yes, you're not going to know everything, but I've always thought that most CTAs going back 10, 20, 30, 40, 50 years, when you can look at their disclosure documents, there's the performance data. They say, here are the markets that we're trading. They list the markets. You can literally look at the performance data and then look at particular markets and see, oh, okay, they had a big month this month. Oh, what was going on this month? Oh, look, oil really rammed up this month. And you can piece it together. So I've always found the black box criticism unusual, because if you really wanted to do your homework, you could wrap your arms around it a little bit more than just screaming, oh, these guys are black box and it's some secret magical formula. I've always thought that's a little unfair. How do you feel about the black box idea?
One of the things that we did in our book, which I think is a fun part of it, is we use one equation. That's the only equation, and it's just how you decide your positions. And what I would say is that people call it's a black box until you know what's inside of it. So I think that if we can create a framework where investors understand this equation and understand sort of how there are different perturbations of it, it's no longer a black box to me. I mean, I think the black box thing is an easy way to sort of, I mean, if that's the case, then pretty much every hedge fund strategy outside of trend following is an even bigger black box, because they don't disclose their exact algorithms for how do you take this exact position in that company. I think that the black box is a sort of an easy way to sort of disregard something that you may not understand why it works.
So do you think that you and Alex have scared anybody else away from doing a 450-page academic proof of trend following?
I'm sure there'll be more.
I don't know. I'm not lifting a finger to compete with that beast. No way.
It's the trend, right? So there'll be another, that's how it works, right?
I don't know. You guys, I think it was nice too, is it really, I think you consciously, you both wanted to make something that really was not, I've mentioned some names and I've added a little color to this conversation, but let me be clear, your book is really meat and potatoes. There are really not names in there. You guys really break this down. It's one massive academic proof paper. I think it's a fair way to characterize it, isn't it?
Yeah, and I think, we wanted it to be accessible as if it could be taught, but one of the key things to this book was that Alex and I came together independently, and we sort of worked together, and we worked to tell the story of trend following that we thought was necessary. And I think one of the hard parts with that is that we, as a result, tried to be as objective and as academic as we possibly could.
Yeah.
To sort of make that point. And I think that has some power to it, because we're not trying to sort of put anything into context. We're just trying to give a framework for how to think about why these strategies work, and hoping that other people can take this and use this and be able to communicate these ideas to others.
Well, I know for the longest time in the academic community, a gentleman down there at Duke, David Shea and William Fung, who's not at Duke, but together their papers were a real foundation for a long time. But there was not much else after that, relatively speaking, in the academic community. I mean, there's been some papers, and it's, as you said, in the last 3 or 4 years, there's been more. And obviously some funds have put some out. AQR has put a paper out, and obviously ISAM has put some papers out. But I think your work is really laying down the gauntlet in the academic community of like, hey, let's play ball. You guys want to have a debate? Okay, we've got something to debate with now.
Yeah, our main goal was, and I think that was the idea of having a book, because someone just the other day, I was at Quantinvest, and someone was asking me, why did you write a book? Why would you do that? And I laughed, and I was like, well, because I just felt that there was so much information, and it needed to be in one place. And it needed to be consistent, and it needed to be consistent from the beginning to the end, so that someone can read about trend following from an objective perspective and really sort of understand both the ideologies, the science, the art, how to use it in their portfolio, everything all in one shot. Because that's not that easy to do with papers, because they're all over the place, right? And there's a good one from this manager and a good one from another manager, and then there's one opinion on this paper and one opinion on another, and you have to put them all together, and it's just not as clear.
Just between you and I, so even obviously I've put some books down in this world, and other people have done it, and now you guys put this academic beast down. Acceptance. Even though if somebody really wants to take the time, there is a way for them to wrap their arms around the benefits of a divergent style of trading, like trend following, having the ability to try and target that crisis alpha. 5 years from now, how much of a dent do you think it really gets made in the acceptance side of the equation?
I think it's a slow process, and I mean, if anybody knows that, you definitely know more, because I mean, you've spent so much time working and educating people on trend following as well, and you know that these things take time. I mean, some people, especially new people to the field who are young, lower level analysts and getting out and first discovering these strategies, that they're going to be easier to convince. And, we'll see.
Do you think, though, at the heart of Daniel Kahneman's work, and do you think at the heart of the most assets out there in this long only bias, doesn't that really, that's you got the human condition working against you? I am not asking you for a prediction or anything. I just sometimes wonder if it will. There's always going to be people out there, and for those that want to start a business around this strategy or trade for clients, there's always going to be an opportunity. But I just wonder sometimes if the vast majority of people, many of which could obviously use a divergent strategy in their life for some benefits, I just sometimes wonder if the acceptance will ever be here, at least in this particular lifetime.
Well, I think it will. I mean, I think there's tremendous momentum, especially since, just being geeky there. The fact that they have been publishing papers in the Journal of Finance on this, the fact that people are sort of institutional investors are really embraced this strategy, I think that's really a telltale sign that we are becoming more accepted as a standard of, just like value investing, same thing. I think in the future it will be as accepted. I don't think everyone will use it, but I think more and more people are understanding the value of trend following.
Yeah, I think that's a good way to say it. I think you're right about there. I think people will understand it. Whether they pull the trigger becomes a different issue altogether. When I look at the industry, there's the names that I know, but I always wonder about the names that I don't know. The reclusive Swiss billionaire who's been doing this for 40 years and just no one knows of him. I mean, there's got to be around the world people that have been practicing the art and science of this and just have decided they don't want any part of the debate because they know how much money it makes for them.
Well, it's the same idea. I mean, do you know how many pension funds? I mean, you must have this all the time. When you talk to pension funds, they hire someone, they do it in-house.
Yeah.
And so they don't call themselves a trend following manager, but they just use it as part of their strategy and futures. And then they just don't label it as that. I mean, I think if the assets under management is worth 300, then I estimate it at 6.
Yeah.
Sometimes, because I know the large pension funds, they're doing it internally, and they come up to me and ask me how to do it. I say, "Oh, good. I'm gonna read this book, your book, and this happened to me last week. I'm gonna read your book because I'm gonna implement it for our pension fund."
I'll have to bring it up with Alex in our conversation when we talk, but I think one of the things we didn't talk about today, and you talk about, let's say, other styles of hedge fund investing, their lack of transparency. But I think one of the great things about this, the trend following divergent style, is the systematic aspect to it. I mean, it's such that you can put some systems in place that everyone can know and follow. And it's not just about trusting, I'm going to say this in a mean sort of way, it's not about just trusting the fat guy in the corner who's sitting at an odd shaped desk who screams at everybody because he's made some money for the last 5 or 6 years and you just have to trust him. It's something a little more rational than that.
The systematic part of trend following is its strength. Because if you think about the behavioral perspective, I mean, the best way, this is why I've been so fascinated by heuristics, but the way that we handle our behavior sometimes is we try and create rules that help us to sort of deal with not doing the wrong thing in the wrong moment. And this is what systematic trend following is about. It's about having an approach which is systematic, that's thoroughly designed and is sort of well thought out, as opposed to following our gut emotion in any particular moment.
Otherwise, it would be described as every video montage or picture of Wall Street presented in a film or on a TV in the last 30 or 40 years is always, people running around screaming, the trading floor at the Mercantile Exchange, which is never about trend following. Those guys you see that used to be screaming on the floor, they were never trend followers. They were scalping.
Never.
Yeah. So, I mean, there's always these misconceptions about what it really is. And I still remember going to Bill Dunn's office for the first time, and I thought I was in a CPA's office. I mean, you just, there's no activity, that's not relevant to making money.
Yeah, I think it's great because, we were here in Stockholm and we had a CTA panel, and there had been an article out in The Economist that said, technical traders are sanguine to the situation, and so I brought this up to the panel, and we had, the CEO of Lynx, and he sat there and he goes, yeah, we're doing what we're supposed to do. We can't tell you when the market's going to change, and we're going to do things the way that, we're not going to change our systems. We're going to, and pretty much every trend follower on the list there just said, this is what we do, and we believe in what we do, and we're not going to sort of change because of an emotion right now. And I think that's sort of the thing that some people don't have, some of the ideology that you have to get used to in trend following, that people think that there's a lot of emotion and it's about this and that. No, it's about a systematic approach, and it's about a risk-taking methodology. And it's not about sort of, so you hear some rumor and then you go. It's not like that at all. So.
Yeah. Catherine, listen, it's been a pleasure having you on today. The book is Trend Following with Managed Futures, The Search for Crisis Alpha, authored with Alex Gracerman of ISAM. Alex has been on my podcast before. I'm going to have him on again because this book is dense enough that we can have several conversations about it. Catherine, where else can people, I'm sure they can Google your name and find your academic site where you are in Sweden. Is that the best place to look for you?
Yes, they can look me up at the Swedish House of Finance, and I'm also working at the Institute for Financial Research here in Sweden. So they're more than welcome to look me up and email me from that website.
Hey, listen, thank you for coming on today, and I appreciate it, and hopefully we can talk again in the future.
Sounds excellent. Nice to meet you, Michael.
Nice to meet you.
Catherine Catherine Kaminsky. This is Catherine's second visit to my show. She came on last year discussing her new book. Today, she's discussing a new white paper, specifically diving into correlation among traders. A deep dive, but a really important critical distinction that she makes in this new research. Also, Catherine recently joined Campbell and Company, one of the oldest, if not oldest, CTAs in existence, with much trend following expertise dating back to the 1970s up to today, never stopped, a very successful firm. I hope you enjoy this conversation with Catherine Kaminsky. Catherine, today, and I think people really need to go back and listen to our first conversation, but today what I really want to get into is you've got this cool white paper that you put out at Campbell and Company called Return Dispersion, Counterintuitive Correlation, subtitled The Role of Diversification in CTA Portfolios. I really did not know what I was walking into as I started underlining and going through this about a 10-page white paper. But I started to realize there's something really interesting, and you're going to be able to kind of flesh this out. But over the years, I have noticed, and I'm sure other people have noticed too, that when there are big performing months in the CTA managed futures trend following space, that often managers that might have high correlation don't necessarily at those opportune times don't necessarily always have correlated results right at that very opportune time for that particular type of strategy. Am I onto something? Is this where you were diving into?
What happens is you have a strategy space where most of the strategies are very diversified. So when you have such diversified strategies, we try to explain that therefore the correlation will be high between the strategies on average a lot of the times. But what happens is that specifically when people want performance, so a year like 2014, which is a great year for the CTA space, the strategy in terms of performance can be all over the map. That's kind of counterintuitive to a lot of investors who say, well, I thought that, A and B and C were all the same, but yet when I really needed and really got performance, A was over here, C didn't do anything, and B was, who knows, so I think this is sort of a counterintuitive issue in the CTA space, which has to do with the fact that momentum as a premium is a little bit, it can come in spurts and periods like 2004. And when that happens, it turns out that we tend to be those little differences between how we do risk management, between what we focus on, seem to sort of be exacerbated in these moments.
And when you just said 2004, you meant 2014.
2014, yeah.
Let's before we dive into it though, let's take a bigger step back and let's just talk about, for example, because you mentioned this in your paper, 2014 was the return, so to speak, of these types of strategies. Now, for someone you've written a great book with Alex Gracerman about trend following with managed futures, but why don't you talk about the notion that how, just like within the last few years, we've seen the titles, these strategies are dead, and then all of a sudden they're back alive in 2014. That predicate to begin with is off. I mean, the media's understanding of these types of strategies is off to say that a down period, it's dead, and then when it has an up period, it's alive. But the reality is, anyone that looks at the performance track record of this style of trading is going to see this variability from the outset.
Yeah, I mean, I think it's a natural human tendency, especially for strategies where one of the biggest challenges that we have in the systematic space and in the CTA space is that if people see us as a black box, they're much faster to throw the black box away. It's sort of like the television that, it doesn't work. And some people's solution to that is to hit the television or to, so I think if you don't, when you understand how the strategy works and you get used to it and understand how to use it over the long run, of short periods even long periods of underperformance, if they're not really, really out of the norm, would be expected for pretty much anything that you invest in. The same thing happens in stocks, but somehow we seem to be less upset about that. And I think that has to do with the fact that we understand and we feel like we understand how stocks work. So we naturally more accepting of drawdowns in things that we feel comfortable with.
You bring up stocks. Why don't we talk about diversification from a 36,000 foot peak for a moment, and talk about diversification as commonly understood in the equity world, the benefits, how it works, and why don't you transition that type of thinking over to the CTA world in terms of diversification as well?
I think that's a really good point. We've sometimes, some of my colleagues, and even in the past with friends in the CTA space, we tend to have a very different view about how we do diversification, in the sense that we tend to focus mostly on risk. And we see that return, for example, is really difficult to predict. But risk is something that you can at least manage and control. And I think that when we deal with diversification, what we're trying to do is spread our risk across as many opportunities and use as much information as possible to predict the level of risk. And in rare cases, the predictability of return. I think that the standard traditional economic framework for dealing with stocks and bond allocation is more, you have a return target, and then you minimize your risk as a function of the return target. We sort of, from past experience, tend to think that diversification comes from allocating across risk. And a lot of the research has shown that risk is a much easier thing to sort of attempt to measure and attempt to control than return.
I think one of the interesting things you do in this piece as well is you say that, look, there can be one core, for example, if we're talking trend following, there could be one core trend following strategy. There could be varying levels of risk chosen. There could be various parameter sets. The timing of those returns could differ. And I think what's really interesting, that you kind of a novel way of saying it, is that one trend following strategy is conceptually similar to one stock.
Yes. And I really like that analogy, because what you can say then is, if you invest in one stock, you have tons of idiosyncratic risk in terms of just the sort of noise and risk that you're not getting paid for. So if you have one way of investing in trend following, so one strategy, one set of parameters has the same level of idiosyncratic risk. And so how we build portfolios is to add as many of those as possible. That's why we have to be systematic. Because if we're not, then we have too much idiosyncratic risk, because the risk-reward trade-off in such competitive markets like futures, and I think you've probably had other discussions with people about this, trend follow one asset. It's tough.
It's impossible. Trend following one asset is buying and holding the S&P.
Yeah. So that's the issue, is that if you can't sort of combine those parameters into a portfolio, then you end up with too much idiosyncratic noise. So for someone who's new to this space, you can do a simple analogy and say, it's like one stock. If you invest in only Apple, you're going to be all over the place. You may have still an okay strategy, but the risk is going to be too much.
Yeah, but from a diversification standpoint, though, I think the analogy is really cool, but the one stock is generally one stock. But even if, let's say, one particular trend following strategy employed by a manager is just one set of parameters, at least that performance stream is being generated by a diverse portfolio. Whereas, I think it's still interesting to make that comparison to one stock. But I guess it's not exactly a true one-to-one comparison. But I think for the purpose of getting people to think about diversification, correlation, et cetera, I think it's very useful.
Well, the reason this is such an apropos topic as well is that there's been a lot of discussion. I'm sure you've had discussion on this topic as well about, okay, well, momentum is simple. I can give you the rule, and here's the rule, and, that's all you need. And that sort of is a challenge, because we see investors asking us a lot of questions about, what's right for me? Should I have a very simple trend program with, very low fees, or should I have a highly diversified trend, non-trend, and complex, a hedge fund strategy? So I think this is another reason why I thought this was an important thing to think of now, because a lot of people are reading about trend following, learning it, and then thinking, well, I can just do this myself, or I can use this product or that product. And I think that the diversification is where the difference is. We have to remind them to diversify. No matter how they do it, it has to be diversified.
And even though you're at Campbell, and this white paper is on Campbell letterhead, you're really not prescribing a solution here. I think what you're more than trying to do is to generate a conversation, get people thinking about these issues, right?
Yes. And the reason for that is that, honestly, investors are heterogeneous. They have different needs, different wants, different solutions that work for them. But I wanted to sort of say more that they need to understand that diversification you have to be successful in the CTA space, and that there's definitely plenty of ways that you can do it, but it's important to remember that. And the other thing that we focused on, which really bothered me, was this conditional correlation issue. Because a lot of people, when they look at the correlations between managers in this context of CTAs, they assume that high correlation means that you're always going to get the same result. That's something that sort of has been sort of assumed. It's a causality, like, oh, high correlation means same results. But what we show is that high correlation breaks down in periods where you perform. So that means that the only way to protect yourself from that is actually to make sure that you're not just replicating the correlation, but actually diversified across a whole set of strategies so that you can replicate the performance.
I used to make these eyeball correlations over the years, looking at managers, especially at these opportune months or periods. And you could see over time for a particular set, I don't know, maybe 2, 3, 4, would often, even though they could be separated by oceans and have no connection, they truly seem to be, even at the opportune times, their correlation in a good way was right there. But you would clearly see times and events where you'd be like scratching your head going, okay, I know there's leverage differences and parameter choice differences, and people are trying to time when they decide to slice their section of the trend, but you would still shake your head and go, something's unusual so I guess it becomes really tricky and interesting. And I could see the minefield of data to be crunched here. If you start to look at a large number of managers, it starts to get fairly complicated quick, doesn't it?
What I see is a challenge I used to be an allocator, now I'm at a CTA, is that one of the reasons I wanted to go and work at Campbell was because I'm on the front lines and I get to see all the information. And my ultimate goal is to help find better ways to explain these differences, to explain and understand what causes differences between CTAs and how can we improve our systems. I think that's the challenge for the investors, is that, we do look a lot alike, but not all the time. And that's something that, this type of result shows that it is actually very important to understand the subtle differences between managers, between products that momentum trading, between your system and your ones that you're invested in. And I think that gives some pat on the back to the manager selection people that, this is an important thing that they're doing to understand the differences. It gives some credit to the manager selection teams and the allocators in our space who really need to do a lot of hard work to sort of dig down into the details to understand how we are different from each other and what are some of the sort of key issues to think about.
It really is. It's such a big picture, fascinating angle, because whether it's eyeball correlation or crunching the correlation in Excel, you really do see some high correlations, but you looking at the magnitude of the differences at those critical junctures is fascinating, because things do break down. Look, somebody might still have a fantastic performance, but then one of their peers might be head and shoulders above, and then you start to scratch your head and you say, hold on, the correlation is really high, but the actual performance, the absolute return is quite different.
Well, what we find, and I think what this paper hints at, is that there actually are some slants and tilts in terms of how we allocate risk, which can drive these differences. And this is a little similar to some of the work that I had done in the past with Alex on styles, but ultimately we all sort of have a slightly different footprint in terms of certain small factors. So you can take correlation as an example. Let's say that one firm is very, very sensitive in terms of risk allocation to correlation. And then another firm is slightly less sensitive. When you have a really large change in correlation, for some period of time, this can actually cause a dislocation between those two strategies. But usually this dislocation is somewhat temporary, and it will last over maybe a month or two. So let's say something happens, and it happens to be a situation where correlation is very, very important. And modeling correlation is good for this set of strategies. Then that set of strategies will outperform the others. But over the long run, what you see is that, it varies depending on what happens in markets. And it's very difficult to predict whether trends are going to come from correlated markets or if they're going to come from individual markets. And I think that's sort of the subject of current research that I'm doing right now. Because I think that is sort of connecting to risk management is a very important way that we can help understand our performance over time.
Or one last question for today, kind of a curiosity type thought on my own here. And don't beat me up if I don't recall if it's in your book with Alex on page 456. Don't beat me up if I don't recall. But what was the inspiration for this direction? What was the aha moment that kind of got you going down this path for this particular white paper we're talking about today?
For the white paper?
Yeah.
Yes, that's a very good question, because on page, just kidding.
Oh.
No, actually, we have a chapter called Return Dispersion. And this chapter is really, it's quite deep. And it looks at return dispersion in the CTA space and tries to explain that, return dispersion at the levels we see is to be expected between correlated assets. But one thing did stick out to me, which really sort of got me to think about this paper. There was a graph where we conditioned return dispersion, so how spread out managers were, as a function of volatility. All the plots on this point were very, very close together with the exception of one. And that one point was 2008. So it was almost like there was this one situation which just didn't fit into the norm. Now, granted, was a yearly study. So if you go at a yearly frequency, you lose a lot of sort of short-term fluctuations, right? So I thought about that, and it always bothered me. And then when we started looking at return dispersion at a higher interval, we came up with a really interesting metric to estimate correlation point-wise, so on a monthly basis. And you might have seen this in graph 6 in the paper. And when we saw that, what we saw is that implied correlation was very stable over time, but implied correlation just broke apart from time to time in our sample. So that's where sort of the thought came about. This one graph that really bothered me in the book. We didn't talk about it, but it always sort of stuck out, that one point. And then I went back and thought about it again and sort of came up with the results of this paper.
Yeah, because over time, over years, like I say, kind of even eyeball and even some Excel correlation. But I often looked at differences, and sometimes you could directly attribute those differences to leverage choices, but other times you just knew it wasn't a leverage choice. There was something else going on.
Yes, and I think the problem is, and we talked about this in the paper, the problem is that correlation as a measure is not a good way to capture let's say you have a return series, like a correlation series, where you're correlated all the time and occasionally that just breaks apart. If you have a rolling correlation, you won't pick it up. It just sort of will roll down and roll up again. You won't see it as one point causing the entire change in the entire series. It kind of muddies the waters. So when we did this by looking at the cross section on a monthly basis, it was funny because I had some allocators that said to me, I said to them, this is more like how it feels to allocate to CTAs. And they said, yes, this is exactly how we feel. Everything seems the same. And then 1 month comes around and occasionally we're not sure why they're so different. And that kind of told me that there is something to this explanation.
Everybody can find the paper as of right now on the Campbell website. I think this last line, though, I'm going to read. People can go read the paper. I think probably one of the best things is for people to even jump in first. Maybe I'll even say that at the introduction. They should read the paper first. But I love this.
It's only 6 pages, so that's good.
I love this last line, though. High pairwise correlations may underestimate the importance of diversification in CTA portfolios, leaving portfolios undiversified in critical moments for performance, end quote. And that sums it up. I mean, but that's a big thought. And I don't think a lot of people have really sat down and chewed on that one yet.
So I think what we could say is that, if you assume that all strategies are the same, you may miss out in the right moments. I mean, that's maybe an easier way to say it. But I mean, if you assume that all things are the same, you may miss something. So you need to dig a little deeper, and you need to make sure that you have a very diversified approach to investing in the CTA space.
Catherine, you have once again promised there are no free lunches. Where can we send people? I assume the Campbell website, which is campbell.com, right?
Yeah, they can just check out the paper on campbell.com, or if they have any questions, they're free to email me. My email should be on the paper and also, on the website.
Catherine, it's always good talking. Hopefully we can talk again when you write more cool stuff.
Great chatting with you, Michael.
Take care.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.